Almost overnight, $19 trillion in household wealth vanished. Unemployment hit 10%, wiping out 8.7 million jobs, and century-old institutions collapsed into dust. Yet just a few years prior, the global economy felt completely secure. To investors worldwide, U.S. real estate was considered the safest, most stable asset on the planet. How did an asset so thoroughly trusted trigger a domino effect that nearly destroyed the modern financial system? To understand the crash, look at the money supply. Following the 2000 dot-com bust, the Federal Reserve needed to revive the slowing economy. They slashed interest rates 11 times, dropping them to 1.75%, the lowest rate in 40 years. Fed Chair Alan Greenspan drove these policies to keep borrowing extremely cheap. He trusted banks to regulate themselves, all while the U.S. government pushed aggressive legislation to expand home ownership. Flooded with cheap money, lending standards practically disappeared to keep the mortgages flowing. Lenders started writing subprime loans specifically for buyers with bad credit, or absolutely no credit history at all. This reckless environment spawned the ninja loan. No income, no job, no assets. Lenders were eagerly handing out hundreds of thousands of dollars to people who had zero documented ability to pay rent, let alone a massive mortgage. Writing loans you know will fail sounds like financial suicide, but the banks kept writing them anyway, because they believed they had engineered a mathematical way to eliminate the risk of default entirely. Under normal rules, banks are tightly regulated, but over time, a parallel shadow banking system emerged. Investment banks, operating outside those strict rules, began buying up massive amounts of these mortgages so they could package and sell them, meaning they never had to hold the risk themselves. Then in April 2004, the U.S. Securities and Exchange Commission loosened its net capital rule. Large investment banks were previously restricted by a 12-to-1 limit on debt. Now, any bank with over $5 billion in assets was permitted to borrow practically unlimited amounts of money to make highly complex bets. Operating without guardrails and fueled by infinite leverage, these institutions stopped caring about the actual quality of the loans they bought. They only cared about the sheer volume they could push through the machine. To push volume, banks created tools like mortgage-backed securities and collateralized debt obligations, or CDOs. The basic concept: banks took thousands of individual, highly risky red loans and forcefully compressed them together into a single, seemingly solid financial product. Wall Street quantitative analysts built their models on a single massive miscalculation. They assumed that if you distributed these terrible loans across a massive, highly correlated network, the mathematical risk would magically dilute itself until it disappeared. To sell these bundles, the investment banks paid credit rating agencies to evaluate them. Relying on those exact same flawed models, the agencies happily slapped a pristine, perfectly safe AAA rating onto these toxic CDOs. Global investors, desperate for reliable returns, saw that gold standard AAA label and bought in completely. They pumped billions of dollars into a market built entirely on garbage debt. Financial complexity had successfully camouflaged extreme danger. Everyone in the chain was generating enormous profits on paper, completely ignoring the reality of the loans propping the whole thing up. By 2007, the housing frenzy finally peaked. Home prices began to drop, and millions of subprime borrowers, unable to meet their payments, simultaneously defaulted on their mortgages. Subprime lenders went bust. Then in early 2008, Bear Stearns, one of Wall Street's oldest investment banks, imploded under the weight of bad mortgage debt. The Federal Reserve had to broker a desperate fire sale to J.P. Morgan Chase to prevent widespread panic. But the panic was already out of control. On September 15, 2008, the U.S. government refused to save another overexposed giant, Lehman Brothers. Lehman went bankrupt overnight, marking the largest bankruptcy in American history. The contagion was immediate. Credit markets froze entirely. Global trade shrank by nearly 10%, and entire international banking systems, like Iceland's, completely collapsed under the strain. The mathematical models failed because they vastly underestimated how correlated the world had become. Spreading out all that bad debt guaranteed that when one single piece fell, the entire global structure shattered with it. Facing a total economic freeze, the U.S. government stepped in with a $700 billion bank bailout, known as the Troubled Asset Relief Program, injecting taxpayer capital directly into the failing financial institutions. This sparked intense public fury over the concept of moral hazard. The very institutions that gambled recklessly and caused the disaster were saved by taxpayer money, while 4 million ordinary Americans lost their homes to foreclosure. Policymakers scrambled to restart the economy and reform the system. President Barack Obama signed the sweeping Dodd-Frank Act to mandate stricter oversight and stress tests for banks. Still, it took years for household incomes and employment to climb back to previous levels. The 2008 crisis proves that financial innovation is incredibly dangerous when it loses touch with reality. Wall Street never actually solved the problem of risk. They simply buried it under layers of complex math. If a system is too complex to fail, it is too complex to trust.